all investors are faced with this because most investors need and should have some type of fixed income in their portfolios, but there's real risks here, particularly for retired people who can ill afford to lose principal value. So they're stuck with an issue. Is that how do I get income to live on? I mean, how do you get an income off $1 million today? You know, if you're going to buy term deposits.
What do you know about these insurance-based products?
I am not a fan of insurance-based products. I have been insurance licensed. I have sold them. I find, mind you, and I'm not just going to pick on the insurance business. I find, generally speaking, that most manufactured financial products are manufactured to improve the fee revenue for the issuers than for the actual end client.
Most is my comment about limited partnerships too.
Yep.
If 10 of us get together and we decide we're going to buy a building, a good method of buying it, if we're already agreed we're going to buy it, is a limited partnership.
Yeah.
So that's an okay deal. But if I put together a building, then I go out and look for people to buy a share of the building with a limited partnership, that's a lousy deal.
Yeah.
Because it's a manufactured thing too.
Yep.
There's nothing wrong with the concept.
They invent
The concept is what's wrong with it is the way it's sold.
Yep.
Well, sure, and you know all the old problems with that kind of stuff, David. I mean, you buy the properties, you mark them up to put them into the partnership, and then you go off and sell units to the public and all this kind of
Well,
stuff.
the problem with them is that when they sold limited partnerships, particular share of a building, they were saying, well, you know, this is a condominium building that you bought a share in, and the condominiums over there selling for $100,000 type of thing. What people didn't realize is what they were buying was a share of a building of an apartment block.
Yeah.
And nobody's going to go in there and pay the first one to pay $150,000 for something that somebody else is renting for $450.
Sure.
Right.
They don't do it, so
Yeah.
it
So
just doesn't work.
The bottom line, and that's applicable across most of the financial services industry. You know, for example, in the insurance products and so forth. I mean, a lot of it's a return of capital issue. You know,
certainly
it's
Helios
like
and Manulife one.
Right, they're a return of capital issue to reduce. They say they're low taxable, but what?
Yeah,
right.
It's a shell game, and they're actually giving you back your own money, and you think it's income.
Yeah.
So I'm not a great fan of it. I have to say, I mean, there's some.
If it works as a tax vehicle, then maybe,
I'll tell
but
you
if not,
over the years, and I've seen it all. I mean, movies, MERBs, deals, oil and gas deals, mining deals. Anytime you start investing for tax purposes, then you better get you better think again.
Usually a mistake.
It's usually a mistake, not always. And I find, for example, and I always use this, I say, if those deals are such good deals, there's tons of private money around. The private, why are they coming and selling it to you?
Well, that's the kind of thing I'm talking
Exactly.
about. You've got to go.
The good deals are taken up by the guys with deep pockets. They're
Right
not
now.
going to show you a private
Yeah,
deal.
they get their original issues.
If they can't sell it, if they
The
can't.
IPOs. I mean, they don't want it.
they're
Why
going to
should
go
they buy
out.
it from the secondary market.
So my answer is in a lot of these alternate products, there's an illusion of. Let me give you another example of a way some security values have gotten crappy over the last 20 years. Let's take a case of preferred shares. And everybody knows what preferred shares are. Preferreds is that dividends, they are paid out ahead of common stock. When it was hard for companies to raise capital, say back in 1981, 82, they would come out and they would have to, for example, I remember straight preferred shares in those days where you get 15% dividend. But probably the ultimate preferred share in those days was issued by the Husky Oil Corporation. It was a $25 preferred. They would guarantee you in 5 years to buy it back for you at $28.50, so a guaranteed capital gain of $3.50. I think the dividend was 11%.
This is at a time when the interest rate was 17 or 18.
And it was convertible to common. It had a conversion feature. It was secured by plant and equipment. Right? I mean, it was just, they had to beg you on bended knee.
To give them some money.
Okay? They were what's called cumulative. They could not pay a common dividend out until they paid their preferred dividends.
Yep.
Okay. Well, what have you got today out there in preferred land? Brand new preferreds issued by, say, some name corporation, whether it's a bank or a senior blue chip. So they're perpetuals, so there's no fixed redemption date. The company can change the terms. If it goes to the it's callable by the company. If they don't, the terms don't
Yep.
suit them anymore, they can pull
Yep.
it away from you. Interest rates, dividend rate of 4.5%, maybe, and get this, non-cumulative. So they can miss a dividend on that preferred.
And
So if
don't
it's-
have to make it up.
and don't have to make it up. So if it's non-cumulative, why is it preferred?
It's not a preferred share anymore, is it?
That's how far the quality of
The preferred share has
of
gone in
preferred
20
share.
years.
That's the status of the marketplace, right?
In 30 years.
The ball is. I mean, if I was a corporate treasurer right now, if I was to go out and wanted to raise $300 or $400 million for capital purposes, I mean, man, I'd go out and I'd issue a pref for, say, raise $400 million. I'd pay 4% on that money. Means that I've got a forever loan
Yep.
at
Yep.
4.5%.
Yep.
If circumstances go against me, I can get off the bat. Otherwise, I got your money,
Yep.
and I don't got to pay you back
Right.
forever. And if I miss a payment, too bad for you.
Tough luck.
What a corporate treasurer's picnic.
Now,
So
What's the market like in those? I mean, are they selling?
Absolutely.
Well, should we get some?
People like,
Maybe we
no,
should-
because these aren't good ones.
No,
That's
I
what
know,
he's
but
saying.
what I'm saying is maybe we should incorporate and start selling some.
Well, it's a funding arrangement. You're not going to get away with it
No,
unless
I
you're a
know.
name.
I understand.
But that's just an example of how the
So you don't put a lot of preferred shares in your
None.
portfolios for people.
and this is a very dangerous thing, because the reason it's dangerous right now is if you agree with me that interest rates are at a generational low, and you're going to be locked in at 4.5. Let's say interest rates go to 7%. What do you think is going to happen to those preferreds?
Oh, they're going to go way down in value.
It might be $15.
Down
It'll go down from
30%.
25 to 30, 40% decline in
Yep.
capital value. And of course, people are buying these because they go to the bank and they can only get 2% on a GIC. They phone the broker, and the broker says, "Hey, I got a 4.5% preferred dividend
Yeah.
piece
Yep.
with a dividend tax credit. It's almost 6%. What a deal!"
Yep.
Yeah.
And the rest of it's printed in 2-point type at the bottom of the contract.
So it sounds good, right? It's a preferred share. Well, not cumulative, and I mean, most retail investors would not know what non-cumulative means.
Right.
So when the broker gets his commissions, the person's got this stuff, and of course, time goes on, interest rates will go up, and these things will go underwater, and and all you can do is sell them into the market. The second issue with these things is they become very illiquid in the secondary market. So if you've got 2,000 or 3,000 shares of this stuff and you want to kick them out, sell them.
Might take you 6 months.
Well, no, you can't do that because they're going to charge you commission every time. So you got to want to get off of them in one day. So maybe the bid offer spreads out from what should be a quarter point bid, 21.5, 21 3/4. All of a sudden the bid's 19.50 and the offer's 20.5. Spreads out to $1, right? And the reason why is because there's no willing buyers out there. So the market maker has to take them into inventory, and he has to create enough of a spread so he
But
can
he can make
resell
some money
them.
at some point. Yeah.
So you get liquidity problems in these things.
Yeah.
Okay, because they're not an institutional product. Institutions won't buy them. So there's no institutional liquidity there. So that's why you come and hire somebody at Seabank Capital to make sure you don't get caught with.
I knew we were going to get a play. My guest, our guest,
Our guest.
my guest has been Dan Walkow, www.cbankcapital.com. Nobody's phoned in, although we did have a couple of questions. And I want to make it very clear that you can watch this, of course, on reruns. You can watch it on Ustream. You can watch it on YouTube, and you can watch it on www.david-ingram.com. Just about any time after 2 days, because it takes that long for us to get it
Ustream
all
will be up
and-
tonight.
Ustream's up tonight.
Ustream will be up when you stop talking.
Oh, Ustream will be up when I start talking. Stop talking, according to Mitchell, my computer guru over there in the corner, who was the first person ever to show me Ustream, and he showed me Ustream. This is a marvelous thing that anybody can do. If you got a laptop with a webcam, you know how he showed it to me?
No.
I was sitting at my desk over there. He phoned me. He said, "Log on to this, Dad." I logged on. He said, "Acre Madness" or something. I did that, and the next thing I knew, I was watching his teacher at Capilano University teach a course in Egyptian history.
Nice.
And he was doing it with that little notepad
Oh,
over
the
there,
Little Acer
using
Asus.
Ustream.
Asus.
And
Asus.
that was how easy it was to do.